I look at the candlestick, I have to constantly review the charts based on the various signal. So.
Okay, the question, how I come up with support and resistance?
Yes.
I will look at highs and lows like this, okay? Or I would also look at the candlestick signals. For example, here we have a bearish engulfing pattern on the left there, okay? But the main thing is we had a series of highs right around the same resistance area. Okay, but even if you didn't have this, even if we had the bearish engulfing pattern, and then we had that tall white candle at the bearish engulfing pattern's resistance,
Yes.
all right? If there was no turning signals, I would still not want to sell short. It's a small real body. However you define resistance, okay, I'll define it this way or with a candlestick signal. However you define resistance, if there's no sign that the prior trend is losing steam, I would not think about initiating a position.
Okay, thank you.
Okay, and this is, so is the market at resistance? Yes. Are there any reversal signals yet? Now there are. Yes.
So here, even though you see a reversal candle, it's still didn't touch. See, in this case, the resistance zone is like very narrow.
Mm-hmm.
So you still wait. I'm seeing sometimes, many times it happens is, okay, you say a reversal candle, you go short, but it might just go back and spike you up.
Right. The question is, you see, it's over here. Do you just wait? Because what could happen is the market could go up and spike you out. Right. It could happen. But you don't know. To me, this is confirming a resistance area. And if it spikes out on, especially on the close, if you're short, you're wrong. And this is fine for a risk reward, right? Even if you're looking at the recent lows, those lower shadows, okay, my more important support area would be this little piercing pattern in March. But even if you're looking at those lower shadows right around 117.25, this is a fine risk reward. Okay, and this is what happened after. Okay. Although the market is at resistance in that tall white candle, and the resistance area here, we know the market's at resistance. Go back here. Okay. The market is at a resistance area. The analogy I like to make is we know there's resistance there, but we're not going to sell because we don't see the market slowing down. Just as the case would be is if we're crossing the street, we have the light in our favor. We know we have the light in our favor, but wouldn't we wait for the car to slow down before crossing? You know, yes, you're right. You know, you have the light, but if you run down, big deal. You're right, but you're dead. So think of the candlestick signals as giving us a warning that the car is slowing down, the momentum is slowing down. That's what the candlestick screener is all about. You're looking at the market at support or resistance and then screening for candlestick signals to see if that trend is running out of steam. And here again, I'm not real big on trend lines, but just to give you a sense for those who do use angle trend lines. Okay, you can see how we had some upper shadows, small real bodies at the resistance area. Question?
Yes, I think it goes back to the support and resistance question. If you go back to slide 105, you have a bearish, bullish engulfing pattern on the left.
Okay.
Don't you consider that to be a target?
Yes. Oh, on the March lows?
Oh, it's going to be in February 30th.
February. Didn't the market close under the bullish engulfing pattern? Once the bullish engulfing pattern is done, you don't use that as support anymore. Right. I mean, that's not a support area anymore. Okay. Right. Once the market breaks support, once the market broke under support in late February, I don't look at that as a prior support area. Okay. Now, also, in this red circle here, see how the market's having some problems right near resistance area? And although it's making mainly higher highs, it's really struggling with those upper shadows, small real bodies, a couple of lower shadows, but mainly the small real bodies. And actually, the Japanese would say if a market's rising with small real bodies or doji, they'll say it's a market rising in agony. Okay, it's moving up, but it's really, really struggling. And here we had the black candle wrapping around how many white real bodies? God, right. And this brings us to differences between using candles to exit and enter a position. Okay, if we have, like for example here, a candlestick signal confirming a Western signal, we could use that to enter a position. But if you have a candlestick signal that's not confirming a Western signal, I would use that to offset a position. And exiting is very, very important. I had this cartoon made up. You know, not many books written about, not much material written about exiting. And what you could do, in fact, what my friend Ken Calhoun, I don't know how many of you trade stocks, but Ken Calhoun and I have done some joint DVDs. He's president of Day Trading University, and he actually uses 1 and 2 minute intraday setups. He'll look at time and sales, he'll look at breakout plays, and he doesn't use candles to enter a position. What he will look at is initiate the trades, and this is actually on one of our joint DVDs. He will use candles to exit a position. So he'll buy, for example, on a breakout on a 1 or 2 minute chart, and he'll stay in the position until he has 2 or 3 opposing candles or until he gets a bearish candlestick signal. There's nothing wrong with that. If you enter a trade for some other reason, not related to candles, and you see a candlestick signal, for example, a doji that's not confirming something else, nothing wrong with taking profits using candles to exit. So here we have a hammer near a support area. Because that hammer is confirming support, I would use that to initiate long positions. This is the major difference. A candle signal that confirms something else, that confluence, the more indicators the better, that's when we use candles to initiate a new position. When do we use a candle signal to exit a position? If it doesn't confirm something else. So for example, I would use this doji to exit a position. Now, I don't know if it's confirming resistance or not. How would I know if it's confirming resistance? What would I have to do? You have to go back, right? But assuming it's not a confirming resistance area, I would use that doji to exit a long position. If the doji was confirming resistance, I would use that same doji to initiate a new short sale, if the risk reward is good. Can the doji still mean it can go in an uptrend? And the answer is yes, because the doji, all it does is turn the trend from up to neutral. It doesn't turn it from up to down. And in fact, one of the reasons you always have to use stops is, say the market moves up. Let's say the market is overextended here, overbought. Now, as the market, it didn't happen to trade sideways here, but if the market traded sideways for a long period of time, isn't the market relieving its overbought condition? Yes. That, in a sense, is making the market healthier. So how do we know that the market's going to break out above the doji? You have to wait for the market to break out above the doji. That's how you know. Right? No. Well, with this doji, I would use this doji to lighten up on longs. I would not be selling short on this doji. I would take profits, lighten up on longs. Oh, I would definitely lighten up. I would lighten up on longs. Move up stops.